I'm Motley Fool Canada Senior Analyst Nick Seipel, and this is the 5 Minute Major, here to make you a smarter investor in about 5 minutes. Today, we're discussing a stat that really blew my mind about how Canadians are using their TFSA accounts. And more importantly, what they're leaving on the table even after they've done the hard part of saving the money, putting it in the account in the first place. My guest today is Motley Fool Canada Chief Investment Officer Ian Butler. Ian, thanks for joining me.
Great to be here, Nick, on this Masters weekend.
So, Ian, as I said off the top, was looking at some recent data, and what really jumped out at me is that the numbers suggest a significant portion of TFSA holders are not using the account to its biggest advantage. That is tax-free growth on capital gains. That's because most TFSA holders are sticking strictly to cash. About 40% of all TFSA accounts hold cash or guaranteed investment certificates only. And it begs the question, what's going wrong here?
For sure. To me, I think the word savings in the name is doing real damage. People hear tax-free savings account and naturally treat it like a bank account. There's a recent TD survey that we found that when you ask Canadians why they're not investing inside their TFSA, 27% say they want ready availability of their cash, and 22% say they don't even know what products a TFSA can hold. So there's pretty significant degree of ignorance, I might call it, given especially that the TFSAs have been around for a number of years now. They just think it's restricted to savings type products. Reality, though, is a TFSA can hold stocks, ETFs, bonds, mutual funds, basically anything a regular brokerage account can hold. And really, the whole point of the account is that the growth is tax free. If you're just earning 3% in a savings product, you are essentially using a race car to drive to the mailbox. Um, Further, there's a real fear people have of wasting contribution room on a losing investment. So unlike a non-registered brokerage account, you cannot claim capital losses inside a TFSA to offset gains elsewhere. So some people think if I buy a stock and it drops, I've permanently burned that contribution room, which makes them overly cautious and they again default to cash. The logic, though, really works against them. Over any meaningful time horizon, a diversified equity portfolio has dramatically outperformed cash, and the real risk isn't a short-term loss inside the TFSA. It's spending 10 or 20 years earning, say, 3%, when you could be compounding at 7 or 8% tax-free, which is that's what the equity markets provide over a long term. That is contribution room that's really being wasted. It's really come to bear in the numbers. So Statistics Canada data shows Canadians aged 55 to 59 hold an average TFSA balance of just $37,600. Take that $37,600 over a 10-year period at 3%, gets you about $50,000. Put that into the equity markets and call it a 7.5% annualized gain, and you're up around $77,000. So real money is being left on the table by people simply holding cash in their TFSA.
Yeah, and so there's probably some folks watching this video saying, "Oh gosh, I'm one of these folks in that 40% camp. I've only been putting my TFSA in cash." If you're one of those folks, what are some things those investors, those TFSA holders should be thinking about?
Yeah, so the answer is really very straightforward. And again, I think a lot of this comes down to inexperience with equities and a fear of that they are a risky vehicle. We at the Fool are here, of course, to say that is not the case at all with the right time horizon in mind. But one does not have to become a fancy stock picker overnight by any stretch. A single, low cost, globally diversified exchange traded fund ETF can do the heavy lifting for them. Something like ticker symbol XAW on the TSX gives you exposure to US, international, and emerging equities for a very low management expense ratio. Throw a Canadian equity ETF on top of that, and you're looking at a ready-made portfolio, good to go. And again, that just will help people bridge the gap that currently exists and get them into equities instead of cash. And I think another thing that people need to do is just think about what belongs inside the TFSA versus outside of it. And for that, your highest growth investments should be inside the TFSA because that's where the tax-free treatment is most valuable. If you're holding the same guaranteed investment certificate, GIC, you could hold in a regular savings account. You're not really leveraging the account superpower. And again, that is to compound at a tax-free rate. Stocks, equity, ETFs, growth-oriented holdings. That's what the TFSA was built for. So to get going, start today. If you've got cash, go buy an ETF. If you're contributing regularly, set up $250 a month and put it into an ETF. Don't just let it go into cash. 250, 500, whatever the amount. Don't put it into cash. Find a low cost, widely diversified ETF and roll with it.
All right, and that's all we have for this edition of the 5 Minute Major. If you want more stock ideas from us, remember you can click on the icon in the upper right of your corner for more information. Until then, hope to see you next time and Fool on.